Sashi Krishnan joins us, Chief Investment Officer with Birla Sun Life. Sashi, good to have you back on ET Now. Do you think the reaction in bond market and equity market after yesterday's Reserve Bank of India communication is slightly stretched, and there is more than a news reaction, there is a technical reaction which is at play?
Well, I think, Nikunj, this reaction seems to be fairly normal, if you ask me, because what the Reserve Bank of India has done yesterday it's done actually three things. One, very clearly, it has said that it will move up the the rates to 10.25, both the bank rate and the support rate. Secondly, it has said that it will go in for open market sales of something close to around 120 billion. And thirdly, that LAF corridor has been sort of set at 1% of NDTL. Now, very clearly what has happened is that the short-term rates now, or the overnight borrowing rate now, the reference rate becomes 10.25. And given the fact that they're going to suck out rupee liquidity, you will find that the bond markets will react to that. And you will find, the bond yields going up because of both the fact that the short-term yields have moved up and the fact that rupee liquidity has been sucked out. And I think it is fairly natural for bond yields to go up at this point of time. Now, this obviously is a short-term measure, because I think what the RBI seems to have, decided is that it is very important for it to sort of stabilize the rupee at this point of time, because if they do not stabilize the rupee, then you could have larger issues that face the economy. Equity markets obviously have reacted because of the fact that one, interest rates will go up, and two, this sort of increase in interest rates will impact growth, and the growth momentum will sort of start falling. And therefore, you will find that a lot of the industrials, a lot of the infrastructure, a lot of the rate sensitives will obviously react negatively to this RBI step. So I think both the drop in equity markets as well as the increase in yields was a natural fallout of what the RBI did yesterday. The rupee obviously has appreciated, and I think if you ask me, if the RBI continues to take sufficient steps to stabilize the rupee, then you could see the rupee hovering around 60 plus minus 2-3%, which I think is good for the long run.
Sashi, so how do you think would the RBI's move affect the entire banking pack, and would it be a fair assumption that perhaps asset quality would only worsen for the banking pack, in particular the PSUs?
Yes, obviously, I think some of the public-owned banks already have a problem about deteriorating asset qualities, and that is clearly reflected in the valuations. Because if you look at some of the price-to-book books of these government-owned banks, they are at 0.4, 0.5, 0.6 times price-to-book, and that is already reflected in the valuations of many of these banks. To say that the entire banking pack would get significantly impacted, I think is not right, because you do have a large number of, say, private banks that have got a retail liability franchise and a retail lending franchise. And many of those banks that have both the retail liability franchise and the retail lending franchise won't be so badly impacted because of an increase in rates. And therefore, there will be an opportunity to look at buying into that space if the markets correct across the board in the banking sector.
But Sashi, in general, does it make sense now to remain underweight on banks as a group? Because for those who've been overweight on banks for last 4 or 5 years, they've made money. Do you think the overweight trade in the banks or in financials as a group is over?
Correct. So, as a space, I mean, possibly you could be underweight banks, but I said within that sector there will be opportunities where you would be able to identify good retail lending franchises which depend on retail liabilities, and those would still be fairly attractive at this point of time. Now, the unfortunate thing is that many of these private banks which are in this space are at fairly expensive valuations, price to book of 4.5 times to 5 times or 3.5 times to 5 times. In these kind of corrections, what could happen is a lot of these valuations may correct, And it would actually be a good opportunity to look at these seriously in terms of adding to your portfolio.
Are you convinced that it's time to load IT now? Because a struggling company like Infosys has managed to grow in a tough environment. So if a struggling company is growing, it means that names like TCS and HCL Technologies, they could surprise on the upside.
I do tend to agree with you that we should be looking more closely at the IT space because of a couple of reasons. One is that the rupee depreciation clearly has helped them. Two is that we are seeing resurgent growth in the US, and these growth numbers are fairly strong. And therefore you will find discretionary spend, especially in the IT sector, sort of increasing. And along with the rupee depreciation, the IT stocks will sort of tend to benefit significantly. Secondly, I think given the fact that many of these IT companies went through tough times, a lot of those people have tightened ship. They've improved on their business models, and clearly they are now engineered to take advantage of any uptick in growth in US and Europe, and the fact that the rupee has depreciated. So I think it would be an interesting space to watch, and some of them will sort of surprise us positively on the upside.
Besides IT then, Sashi, this earnings season, what do you think could showcase a meaningful upside, or do you think it is going to be another lackluster quarter by India?
Yeah, if you look at earnings expectation as a whole, I think there is not much that we expect, and we think it's going to be another lackluster quarter. If you look at the Sensex estimates that we have for 2014, we've got earnings estimates of something like 1,250, a sort of 8% CAGR earnings growth or so, and nothing more than that. But what I'd like to point out is that, if you go back into history, you will find that the lowest earnings growth that we've ever had, was in the range of around 5 to 6%. Obviously, the highest earnings growth that we had was close to around 22% on a quarterly basis. And therefore, at 8% earnings growth for 2014, I think we are very, very close to a bottom. And if you ask me, post 2014, I would see earnings growth sort of picking up. And therefore, if you get opportunities in these kind of markets, I think there would be, great opportunities to sort of pick up, stocks that are at, very, very deep discount, value stocks that have been sort of beaten down. Because I think earnings growth will come back, and we are closer to a bottom than, seeing significant further deterioration.
Give me an example of what is on your radar. You're sounding it make very simple, that it's time to shop, but shop what?
Well, if you ask me what will I avoid, let me start off with that. Obviously, I'd stay away from the rate sensitives for some time till there is greater clarity in terms of how short term is RBI's defense of the rupee, and does the defense of the rupee mean that you could have a quantitative sort of tightening coming through? If that is not true, then maybe I'd start looking at rate sensitives a little later. But if I stay away from the rate sensitives at this point of time, then I think some of the places that look interesting at this point of time is clearly the pharmaceutical sector, because they have sort of benefited from the rupee depreciation. They will benefit from the US economy, very similar to how the IT sector will do. The other places that look good is, for example, the utility sector, because I think they are strong franchises, and though valuations on some of these stocks are a little, expensive, any kind of correction could sort of afford us an opportunity to buy into these sectors. The private banks, clearly the banks that have got a retail liability franchise and a retail lending franchise could be a good space to be in. So even in this market, I think you will find reasonable ideas to invest in. And if you ask me, I think the markets are going to be very range bound. So if you ask me for a range, I'd say 1750 to 21,500. And at the lower end of the of this range, I think if you get opportunities to buy, you must start accumulating. And I think this would be a good opportunity.